Next question. Mr. A has rupees 10,000 invested in long-term corporate bond. This bond portfolio's expected annual return is 9% and annual standard deviation is 10%. Mr. B, financial advisor, recommends that Mr. A consider investing in an index fund which closely tracks Standard and Poor 500 index. The index has an expected return of 14% and its standard deviation is 16%. Suppose Mr. A puts all his money in a combination of the index fund and treasury bill. Can he thereby improve his expected rate of return without changing risk of his portfolio? That is the question. Treasury bill yield is 6%, that is risk-free rate of return is 6%. Could Mr. A do even better by investing equal amount in the corporate bond portfolio and index fund? That is the question. The correlation between the bond portfolio and index fund is 0.10. That is the question. So over here, say I want you to tell me answer of the first part of the question in the chat box. Please give your answer in the chat box. Let us have understanding that say how to make the calculation of answer over here. See, the question is providing the information like this, that Mr. A has made an amount of investment. This 10,000 or 10 lakh or 1 million, that does not make any difference. Invested in long-term corporate bond. So this is important. This bond portfolio's return is 9 and standard deviation is 10. So what I have written is that, say, let us assume X variable, let us assign X variable to the long-term corporate bond. It has a return of 9 and standard deviation of 10. Mr. B, financial advisor, recommends that Mr. A consider investing in index fund which closely tracks Standard and Poor 500 index. The term Standard and Poor 500 index is nothing else but, in a simple language, it is the Nifty, it is like Sensex. The way we have the Nifty and Sensex in India, similarly in United States of America, it is Standard and Poor 500 index. So they have only provided that, say, this index fund is similar to the market portfolio. That is what, say, they have provided. The index has an expected return of 14%. So the information is given that, say, it has a return of 14% and its standard deviation is 16%. Suppose Mr. A puts all his money in a combination of index fund and treasury bill, that is Y and RF. Can he thereby improve his expected rate of return without changing risk of his portfolio? That is a question. Treasury bill yield means treasury bill return is 6%. So if at all, so the investor is, say, instead of making investment only in X, suppose he is investing in Y and RF, then in that case, can he thereby improve his expected rate of return? That is a question, without changing risk of his portfolio. So we understand that, say, the new portfolio, that is combination of Y and RF, will have the standard deviation of 10%. That is the current standard deviation. With that, say, we are required to compute first of all the proportion in which the investment to be made in this two, which will have the standard deviation of 10%. Suppose the answer comes to 60-40 or 70, that is a 70-30 or something like that. Whatever the proportion in which the investment is made, for that proportion, what is the return of the portfolio is required to be found. If at all the return of the portfolio is greater than 9%, then in that case we will say that yes, he can improve his rate of return without changing risk of the portfolio and vice versa. This is the way we are required to give answer for the first part of the question. So let us make calculation of answer. Working note number 1, calculation of WY. What is WY? The proportion of the funds to be invested in index fund, so that the standard deviation of the portfolio is 10%. It is sigma P divided by sigma Y. So 10 upon 16, 0.6250. This is the way we can compute the WY. Working note number 2, calculation of the return of this portfolio. WY into RY plus WRF into return of RF. What is WY? It is 0.6250 into what is return of the portfolio? Return of the portfolio is say 14%. That is return of the index fund. 1 minus 0.625 into 6%. 625 into 14, that is 8.75. 0.375 into 6, that comes to 2.25. That comes to 11%. Now, if at all the investor will switch over the entire portfolio from long-term corporate bond, say, to index fund and treasury bill, then in that case, for the same risk of 10%, he will be able to get the return of 11% instead of 9%. So we can say that yes, whatever Mr. B has advised is very correct. If at all the investment is made in this combination, then in that case, for the same risk, you will be able to get more return. So write down answer. Based on above working, comma, we can conclude that for same risk, more return is possible if investor will invest in a combination of index fund and treasury bill. Full stop. Further in that, write down for same risk of 10%, return increases from 9% to 11%. This is what we understand. Next question. Could Mr. A do even better by investing equal amount in corporate bond portfolio and index fund? Correlation coefficient, that is R, between bond portfolio and index fund is 0.10. Again, I want you to answer this question in the chat box. So now friends, over here we are required to check the return and risk for a portfolio if at all you make investment in a combination of long-term corporate bond and in index fund. In what proportion do you make investment? 50-50. So use your calculator. 9 into 0.5, that comes to 4.5, and 14 into 0.5, that comes to 7. So 7 plus 4.5, that comes to 11.5 percentage. So when you make investment in both of them in equal proportion, the return will be 11.5 percentage. So this 11.5% is of course exceeding the 11 percentage. That is the return that we have found over here. So in terms of the return, yes, the return is more than 11 percentage. However, the story does not end over here. If at all you make investment in this too, then in that case, what would be the standard deviation is required to be computed. In order to compute the standard deviation of this portfolio, we have been provided with the information that what kind of correlation coefficient that both of them have with one another. It is 0.10. So we are required to apply that simple formula for the purpose of making calculation of standard deviation of the portfolio. And based on that, say we will be able to draw the conclusion that say whether Mr. A can do even better or not by making investment in this two in equal proportion. So let us answer the question. Answer for the second part of the question. In that, write down. If investment is made in these two securities, in equal proportion, comma, then RP return of the portfolio and sigma P standard deviation of portfolio can be found as under. So in that we understand like this. Return of the portfolio is weight of X into return of X plus weight of Y into return of Y. So it is 0.50, 0.50. Return is provided to us as 9 percentage, and over here, so the return is provided as 14 percentage. This is 9 and this is 14. So 4.5 plus 7, that comes to 11.5 percentage. This is the way the return of the portfolio can be calculated. Calculation of the variance of the portfolio. How to compute the variance of the portfolio? Wx square sigma x square, Wy square sigma y square, 2r Wx sigma x, Wy sigma y. That is the way the variance of the portfolio can be found. So 0.5 raised to 2 into, again 0.5 raised to 2 into, as far as the standard deviation is concerned, this is 10 percentage and this is 16 percentage. Two into R is correlation coefficient 0.10 into weight of X, weight of Y, standard deviation X, standard deviation Y. Square of 10 is 100, square of 0.5 is 0.25, so this is 25. Square of 16 is 256 into square of 0.5 is 0.25, that comes to 64. Then 2 into R 0.10 into zero point 0.5 into zero point 0.5 into 10 into 16, that comes to 8. So 25 plus 8 plus 64, that comes to 97. This is the way we can compute the variance. Once you compute the variance, then standard deviation of the portfolio is very simple. Sigma p is root of the variance, that is 9.8489. That is the way, so the standard deviation of the portfolio can be calculated. So we understand that so the investment in long-term corporate bond, then investment in index fund and a treasury bill, and lastly investment in long-term corporate bond and index fund. These are the three investment options that we have. In that, so the return and risk. We understand that so the risk is 10% and return is 9%. In A part of the question, we have found that so the return increases to 11 and the risk is remaining same, and accordingly only we had formed the portfolio. In the second part of the question, return increases to 11.5% and the risk reduces to 9.8489%. That is the way, so we will be having so the return and risk so for the different portfolios. So of course the conclusion is that say yes, you can do even better by making investment in a combination of the long-term corporate bond and index fund. So let an answer. Mr. A can do even better, comma, by combining long-term corporate bond and index fund, comma, return increase to 11.5 and risk reduce to 9.85. So 9.8489. This is what we understand. So finally we understand something like this, that there are three securities for which information is given. In that, say in first security you already have an investment. The question says that say if at all you combine second and third security, that is index fund and treasury bill, can you improve the return without changing the risk? And we have made the computation that yes, you can improve. Then the second part of the question says that say, can you do even better if at all you combine the first and second security in equal proportion? And for that, say again we have made the calculation and we found that yes, you are able to improve the return, and along with that, say you are able to reduce the risk. This is the way, say we can give the answer for the question.